Hi, I'm Mike Sibley, leader of the James Moore manufacturing team. I'm here with Kevin Golden, one of my partners, and a member of the James Moore manufacturing team as well. Today, we are joined by John VanDuzer and Kris Hutchins. John is a partner and tax service line leader at James Moore, and Kris is a client service director at James Moore and a leader in our research and development tax credit department, and also a member of our manufacturing team. Today's episode is a detailed look at the One Big Beautiful Act. Recently passed in July. This act really applies to individuals, a lot of different industries, but really this thing seems like it was written for manufacturers. There's so many different components that are great for manufacturers, a lot of favorable provisions. We're really excited about it just because of the impact it can have in so many different dimensions. So we're excited to welcome John and Kris to the show to help go over some of the key highlights of this beautiful act, I guess we'll call it. So welcome to the show, guys.
Hey, Mike, Kevin, thank you for having us. Yeah, we're really excited about this bill too. I think there's a lot of taxpayer favorable provisions. And like you mentioned, it is very heavily favored towards the manufacturing industry.
Awesome. Well, let's dive right into it. There's over 800 pages. So there's a lot in there to cover. But anytime we're talking with our manufacturing clients, the community and so forth, the thing that always comes top first, or usually near the top, is research and development. So I know, Kris, you're in the R&D and part of our R&D team, one of our leaders there. So how did all the R&D shake up? What changed? What's the same? What's different with OBBBA, we'll call it for this conversation, with this legislation that passed?
Yeah, no, it's we finally got what we were been asking for the past couple of years. So to kind of go back a little bit, starting in 2022, we had to start capitalizing our R&D expenses. And what that means is you basically, take the expenses that you had in the year that you paid for them, but you have to spread out your deduction over 5 years for U.S. Sourced expenses or 15 years for foreign. And it really made it kind of difficult for, in cash flow, really hard for a lot of manufacturers that were investing in innovation and really kind of pushing forward on a lot of these R&D activities, because you weren't getting that benefit when you really were actually outlaying the cash. And so what this bill really came back and did is for those US based expenses, you can now take that deduction in the year that you're paying for those and not have to spread it out over 5 years. So it was really, really big for a lot of those manufacturing companies. It does keep the rule for foreign US or foreign R&D expenses. So one of the themes you'll kind of see here in a lot of this bill is it's really pushing to bring manufacturing back into the US. So this is one of those things where you can see that real big push on it, that you get the benefit for US R&D expenses, but your foreign expenses still have to be capitalized over 15 years. So really big win here for manufacturers. And we're excited to see that we're going to be able to now what we kind of take basically almost like a double benefit. You're going to be able to deduct your expenses, your R&D expenses in the year that you pay for them. And you're also going to get that R&D credit, the R&D tax credit. So nothing changed with the R&D tax credit. All those calculations and everything all stayed the same. But you're able to kind of take advantage of both of these things. And that's really, really big for them.
No, Kris, it's in R&D. Like, what do you mean from a tax perspective? Like, what's the tax definition of R&D? And then what's kind of high level? What's the benefit of the credit?
Yeah, so it's a really great question, because I think typically, we've talked about this in the past, that, you think R&D is your lab coats and your beakers and your very scientific things, but it really encompasses a lot of different activities. And manufacturing really is an industry that it focuses on. So you have to meet a 4-part test. The IRS has a 4-part test for it to qualify as an R&D activity. So the first part is a permitted purpose. So are you creating or improving a product, process, formula, something about your business that you are either using internally for yourselves or will be selling to customers? And this is, creating something. It doesn't have to be new to the world. It could be new to you. So even if you were, just working through different pieces on things, it may exist somewhere else out there in the world, but you may not have the exact kind of specifications for it and you're working on it for your specific business, that can still qualify. The second piece is, are you working in the hard sciences? Are you working in science, engineering, those sorts of things? Typically not your psychology, social sciences is really where we're kind of including a lot of those things. The third part is, are you working through a process of experimentations? So are you testing different methods, different hypotheses, to see how to create these products, how to improve these things that you're working on? And the fourth part there is like, are you trying to undo some uncertainties? There's something on the onset of this project that you just don't know how to solve. So is it the types of materials, which materials are best, the most cost effective, different things like that that go into those products? That qualifies as R&D for IRS purposes. And so what happens through these to get that credit is we kind of collect these expenses, whether they're wages, contract labor, supplies are the three major ones. We collect those expenses and then you're going to get a tax credit, which is better than a deduction. So how it kind of works is you take, let's say you had $100 of revenue in a year and you have $50 of expenses. Your net income there is $50 and that's what gets taxed. If you had a credit then of $10, that's going to offset directly that tax liability. So it's basically like making a payment to the IRS that you don't have to come out of pocket for cash wise. So they're pretty valuable.
Right.
Pretty valuable.
And going back a second, you said foreign to, I mean, today's day and age, it's almost hard. Even the smaller size manufacturers got some sort of foreign aspect to their, process, whether it's in their supply chain, whether they actually have people working overseas or some variation of that. So when you said that foreign, those R&D expenses and so forth are still over 15 years, what type of expenses are common that we're referring to as foreign? Are we talking about, the fact that I have a piece of equipment or some supplies or something produced overseas and shipped in, and those now I have to track those, or kind of spell that out? How in detail do we need to be about those, and versus U.S. base, which is now expensed directly?
Yeah. So when I say foreign, it means are the activities taking place overseas? So if you're bringing in equipment that, maybe you're purchasing it from a foreign producer and you're shipping it in and you're using it in the US, that's a US expense. What you typically see as a big one would be like a software developer that is doing development work in India, in the Philippines, like one of those that development activity is happening overseas. Or if you have like a manufacturing plant overseas and you're doing R&D work physically in another location internationally, that's where that's going to go into that foreign bucket and would still have to get capitalized there.
Yeah, great. I just didn't want our viewers thinking, oh gosh, I hear foreign at all, then I may have to.
Exactly.
Okay, think of it where it's produced, where it's manufactured, where is it being used, or where is your product being produced. That's very helpful. Thank you.
Yeah. And the other thing
we have one. And we have, one of the good things is we've got some other podcasts we've done on R&D that really, really go into a little bit deeper. But I'm curious, Kris, Kevin mentioned 800 pages of legislation. I think we're still waiting on regulations to is there anything related to the R&D credit that we're waiting on hearing about, anything uncertain, or is it pretty straightforward, go back to kind of the old days?
Yeah. So it's typical with IRS, I think legislation, we're waiting on a lot of guidance, and R&D is probably one of the biggest areas right now that we're waiting on, actually. So there are some additional things in there that, let's say, what happens to all these R&D expenses that I've had to capitalize now for these last couple of years? What do I get to do with those? And the legislation was very specific that if you are a small business, and they qualified that as anybody under 31 million of gross receipts for a last 3-year average, you can actually go back and amend those returns and take those deductions that you missed out on those years. What is uncertain and kind of a little bit of a gray area right now, and this is what we're waiting on, is, well, what happens for a 2024 tax return that you've not yet filed? You filed an extension, but you've not gone back. Do I have to file and then go back and amend? Or can I just take that deduction in 24? And And unfortunately, we're kind of running up here on time before we get to some tax deadlines. So we're going to have to see how quickly we can get some guidance out of the IRS. That's one of the things that we're kind of waiting on, is some additional clarification around that. But
we think even if they don't go back and amend, there's going to be some avenue to deduct those in the future.
Worst case scenario is you're going to be able to take those expenses on your 2025 return. You'll be able to take them in 25. If for some reason you wanted to spread that out, you can actually take half in 25, half in 26. That's available to everybody, and that's going to be your worst case, is that you just have to wait until your 25 return. But there's some potential out there for some clients under in that small business category to get those deductions back a little bit quicker.
All right, great. So switching gears a little bit, John, one of the other big things coming out of this is depreciation changes, and bonus depreciation was winding its way seemingly down quite a bit. There are limitations on 179. And then there's some other things they built into this with some of the manufacturing production facilities and things of that nature. Can you kind of walk us through, what we're seeing in this bill now and some practical, ways we can be thinking about it from a tax planning standpoint?
Yeah, of course. So you mentioned there's 3 big depreciation provisions in the OBBBA. One is the 179. So 179 allows for immediate expensing of tangible property. So think like equipment and furnishings and things like that. There is a dollar limit that you can expense up to, and it's been expanded to $2.5 million. And then if you add more than $4 million of equipment, the limitation starts to go down. So it's geared towards small and medium-sized taxpayers, the ones that are not adding, tens of millions of dollars of equipment every year. But for those that are a little bit smaller and more measured in their capital expenditures, and this is specifically like equipment and other tangible property. In tandem with that, there's bonus depreciation. Bonus depreciation is set at 100%. And allows for basically immediate expensing of basically any property that's not a building. So land improvements count, equipment counts, furnishing counts. And that allows for 100%. There's no capital expenditure threshold. There's no size threshold for the taxpayer. So it's a very, very favorable provision. And it was set and made permanent. So right now, absent any legislation, there's no end of life on this bonus depreciation. The rules are there to stay. So one interesting thing is you say, okay, well, 179 allows for full expensing and bonus depreciation allows for full expensing. Why are there 2 different provisions and why do we care? Well, this is where the tax planning gets very nuanced. In a lot of states, they actually will disallow bonus depreciation and they'll make it basically add back over some period of time. But they'll allow 179. So as tax advisors, what we're looking at is what's your capital expenditures, what types of assets are you purchasing, and then what states are you filing in, and how could that potentially affect what makes sense to use bonus depreciation on versus 179 on. So that's an area to kind of look at and follow, because that could have drastically different consequences on a state tax level, even though federally you can expense everything.
Right.
So the last category of depreciation, and this is a brand new category. So we're still looking for a lot of IRS guidance on exactly what they meant, but they introduced this concept of qualified production property. And they basically said that qualified production property can be expensed 100%. And so now the devil is in the details of what exactly is qualified production property. So qualified production property is real property that is used for qualified production, meaning manufacturing. You're taking materials and you're having a substantial transformation into a product. And the facility can be expensed 100%. This obviously, if you think about the cost of manufacturing facilities and everything, could be massive. This one does have an end of life. So this one is basically has to be placed in service by 2031. And then kind of some of the details on here is it has to be a new facility. So you have to basically be the first user. Or if it's not a new facility, it could not have any sort of manufacturing activities engaged in that facility for like the last 5 years. So it goes back through January 2021. So like,
So just like basic improvements to an already existing manufacturing facility doesn't necessarily fit in under that.
yeah. And I think what the intent here for legislation, right? Because you always have to look at legislation and say, okay, what was Congress going for? They want new manufacturing facilities, right? They want to expand manufacturing capacity within the US. And so they're incentivizing new manufacturing facilities. So if you build a new manufacturing facility, that would qualify. If you took a space, say, and you repurpose the space. So for instance, say you have a restaurant building and for whatever reason, you go and gut that and that becomes your new manufacturing facility, that potentially could qualify as well because you've changed the use of the property from a restaurant to a manufacturing facility. And then again, we're running absent guidance on exactly what that means. The other part of this legislation that's interesting is they're basically carving out any administrative area within a building. So if you have any offices or common areas or things like that, that doesn't count towards the cost of qualified production properties. So you could build a new manufacturing facility for $10 million, but it's going to take some work to sit down and really parse out, okay, the cost of the facility is $10 million. What costs are related to administrative areas versus non-administrative areas? What's part of the equipment and is not qualified production property at all? And so there's going to be a lot of work, I think, in these facilities to really get a handle on what the costs are. But again, I think there's a massive benefit for this. You kind of
So it's like kind of like almost like what we have right now is cost segregation studies to try to allocate certain costs within a building that you can expense, not necessarily related to manufacturing, but just so kind of essentially almost a cost segregation study for a facility to make sure you're capturing what costs and allocations. And you think about things like wiring that may just be one big number on a contractor invoice, so to speak. And how do you allocate that out?
Yeah. So they're gonna have to take the cost segregations and add another dimension of, okay, you have real property of X. How much of that real property is qualified production property versus how much of that real property is for other purposes and uses. The last point on here, and this is a question actually that I had a client come to me with a week or two ago, is the code says very explicitly that the qualified production activity has to be undertaken by the taxpayer. So if you think from an asset protection standpoint, a very common strategy is, me and Kevin own a manufacturing company. Well, we create a separate building LLC and we rent the facility to the manufacturing company. Well, on a plain reading of the code, that may not qualify because the building LLC is not engaged in a qualified production activity. So obviously this is an area looking for the IRS to really spell out guidance on exactly what that means.
Right.
But really want to watch that and be careful of that so we don't end up with kind of an unintended consequence solely due to the ownership of the building or something like that. So that is one thing to kind of pay attention to.
And John,
So that would force, if that were the case, let's just say you'd almost force a manufacturer, if they wanted that deduction, to put it on their own books.
Yeah.
Which then back to the liability protection issues. So you're looking at, a lot of different factors there. So is there any kind of timeline you think on when this might come out, or is it anybody's guess if they push this stuff out?
Well, we're dealing with government employees. So, unfortunately the IRS is very understaffed. So I don't honestly have no idea. I mean, my hope was that the guidance would be coming out soon. I think from the TCJA experience tells us it's probably gonna be a year or two before we get really good guidance and complete guidance. I think they'll put out intermediary and temporary guidance, so you can start to get an understanding of kind of where their thought process is going. But unfortunately, this process does take a little bit of time. But that being said, I think, we have the code now. We have some base principles to work off of. I think there is the opportunity to do some creative structuring. So, looking at, do we employ holding companies with separate LLCs, or, I think there is the opportunity to really take advantage of this if there's going to be a substantial capital project. But, just a word of caution to really pay attention to what the code says.
Yeah. Well, I think it's probably miraculous enough this wasn't being passed on 6 days before the end of the year. It was more like 6 months. So at least we've got that going for us. Quick question, going back to mentioning a new space, right? That we want to build new manufacturing facilities or repurpose one that, previously wasn't used for manufacturing. Now it is. What about expansions did it speak specifically to maybe expansions? Because as we know, a lot of clients or a lot of existing manufacturers say, hey, great, I'm running at full capacity. I need to, expand. And sometimes it means buying a new building. I think that's a little more straightforward, or building one. But what about expanding? Okay, well, I can build on maybe to my building. I have extra land that I've bought beside me and I can push it on out. Did it speak to that as far as it being applicable, or is that one of those gray areas that we're waiting for more guidance on?
I think it's probably gray. I mean, I'm leaning towards it probably does qualify if you're expanding, because, you're putting in service new buildings. But, that's definitely one of those areas before you sign on the dotted line for an expansion, expecting tax benefits. Certainly want to double check that.
Right. No, awesome. So we talked about research development, talked a lot about depreciation and this, qualified production deduction. What else is in there, Kris or John, as far as anything other provisions specifically that are beneficial to manufacturers that we should be aware of or that would affect manufacturing?
Yeah, I think the next kind of big one is 163J, excuse me, in that's really tying to how much of your interest expense is being deductible. And this is going to really tie into specifically, like if you're in one of these positions where you are adding on to your facility, you are going to be building out new things, and maybe you have to do that through debt. This is going to be really helpful for you. So where we kind of were before, so the 163J was added through the TCJA Act that happened back in 2018. And what this did is it came in and said, let's take your kind of an adjusted taxable income number and multiply that by 30%. And that's going to be basically the ceiling or a limit of what you're going to be able to deduct of your interest expense. And then a few years ago, they said, okay, well, we're going to add in a little bit more. And now we're going to make you not able to add back depreciation and amortization expenses, which increases your base, which gives you a higher limit on what you're able to do. And what this OBBBA bill has come back and done is said we are now going to be able to go back and add back that depreciation and amortization again, kind of going back to where it was the 2018 rules, where that base was a little bit bigger. So as you have more depreciable assets and more depreciation and amortization, you're going to be able to see a lot more deduction here, specifically, especially if you're adding in new facilities and have a lot of those depreciation deductions. You'll see a lot more of that interest expense be able to be deducted, which will be a lot better for manufacturers.
Yeah. I mean, that was a very challenging provision to navigate because you do great planning on some of these capital expenditures. You get some really good depreciation deductions, and then you shoot yourself in the foot because then you can't deduct your interest.
Right.
So I think this is the right move for them to go back and to allow the depreciation as an add back when trying to determine your interest expense deductibility.
Yeah.
Well, you figure it all ties together, right? You're expanding your facilities, expanding, which may mean you're adding automation and you're doing R&D and you're probably financing some of this. Mm-hmm. And so, it all ties together with your ability to finance, improve your cash flows to help offset the immediate costs of that. And then of course, with the previous limitation on this, you're absolutely right, John. You shoot yourself in the foot and you're like, oh, great. I'm not getting all the benefits that I really should, or, I'm not getting this deduction until later on. So I do think it ties it together pretty nicely.
Yeah.
Yeah, absolutely.
Yeah.
Um,
Yeah.
Another provision that's kind of a mixed bag
Mhm.
around the salt cap. So in 2017, the TCJA, which was a Republican-led legislation, they decided to have fun and uh, poke at some of the high tax states that wouldn't necessarily drive their constituency. So they put into place this SALT cap, the state and local tax deduction, where you can only deduct up to $10,000 of state and local taxes, right? So this disproportionately affected states like California, New York, states with high individual income tax rate. So the new legislation comes in and it increases that cap from 10,000 to 40,000. So on the surface, you're like, great, this is much better and improved and is really helpful. But when you start to dig down, kind of in the finer points, there's an income limitation to that, and it's fairly low. It's I think around $500,000 or so of income, and then that benefit starts to phase out. So if you're a high income, high net worth taxpayer, you're still at the $10,000 salt cap, so there's really no benefit to you. I think this is a good launching point to just remember kind of the strategies around state and local taxes. The one of the ones that is probably it was new with the TCJA, but is still very relevant, is called the pass-through entity tax, PTET. And basically, certain states, to get around the federal legislation of non-deductibility on the taxes, passed special provisions that basically you could elect to pay these taxes at an entity level rather than an individual level, and then be able to benefit from the deduction of those taxes. So that's still a valid strategy, and it is something to consider. My only word of caution is, as I was looking at this over the last few weeks, and in one case, I had a client that had an individual net operating loss in a state. And we basically had to decide, okay, if you take the PTET, potentially you could get a deduction, which is going to create a benefit, but then you forego the ability to use this NOL, which is also creating a benefit. So like you're having to kind of somewhat measure, what's the best route to go on this election to decide, where can I get the best benefit. So there's still probably a good deal of strategy involved.
Right.
But this is an area to continue to monitor and to continue taking advantage of.
Yeah. Yeah. Good to know.
Yeah.
What else?
I think the other one, I mean, this received probably a lot of national attention. It's the no tax on overtime or tips. And this isn't going to necessarily, come down to deductions that the company is getting, but your employees are going to be coming to you. And there are some things that are going to be changing that I think manufacturers just need to be aware of. So the first one, no overtime, no tax on overtime. This is going to be a deduction that your employees get on their individual tax returns up to $12,500 for any overtime that would be necessitated under the Fair Labor Act. So this won't apply to, your high executives and, things like that. This would be people that you were tracking your overtime for. But your withholding tables are going to change in 2026. Your W-2 requirements are going to change. So you want to make sure your payroll systems and everything are really up to date with everything that's going to be needed for tracking that.
Right.
And, on kind of an incentive for it, your employees might be more incentivized to do overtime at this point if they can get it tax-free. Double rate.
Just to be clear, you said that is a 2026.
It's going to be, it's effective for 2025, the reporting requirements, but your withholding tables and everything will start changing in 26. So,
Okay.
They did actually, one of the little bit of guidance we've gotten from the IRS is they have come out and said, we're not changing anything this year as far as how much you need to be withholding from your employees. We'll do that in 26, but your reporting requirements will be there for January W-2s when those and things go out. So waiting on some guidance on there as well. I think the other thing there, so the other big one was no tax on tips. And so you may have employees coming to you kind of saying, well, can we just change my pay structure and can we just make it so that I'm paid out as tips instead of, a salary thing? And that's not really going to work. We're waiting on some guidance here as well, but they the code is very clear that it's meant for industries where tips were traditionally done, like your hair salons, your restaurants, your those sorts of things. So not an easy.
Rather than performance bonuses, you mean we can't just call them tips? Is that
Exactly.
If you tip your
Yeah.
manufacturer lately,
great job getting these 10 widgets out. Here's a tip.
Like that tip jar's gonna get a lot bigger. We'll accept only tips, right?
Right.
Yeah. You can see everybody on different lines with their tip jars out.
Yeah.
but I
So,
think these are
definitely
very
more.
good provisions for the workers, though. You think about it in the industries where overtime and tips and everything, like these are great ways for the workers to just get a little bit extra on their tax benefits. So I think that's wonderful.
Exactly right.
On the state tax side, they increased the exemption from the current levels, which was around 13 to 14 million. It was slated to go down to 5 million in 2026, index for inflation. But actually now it's going to go up to $15 million individual or $30 million for a married couple. So that's very good. That will continue to limit the applicability of the estate tax to really the high net worth individuals. So I don't think there's any urgency to go out and do gifting or anything like that, but that's an area that we're constantly trying to monitor with our clients, just to have an understanding of, do you understand what your net worth is? Even if you're not subject to estate taxes, have you done a base level of estate planning that can help cover what happens if you were to pass away unexpectedly, or how are you addressing your heirs and your kids, and do you need a trust? And so there's a whole lot around that is good for everyone, even if you're not in a taxable estate type situation.
Well,
John, is there any kind of time frame on that where it winds back down? Does it stay that? Does it go like, because we're always hearing, okay, remember, like you said, 2026, it was supposed to go back down. And it seems like this is one area where you don't ever get any agreement on. It goes up and some people want to go down. Is there anything on that we need to be aware of?
So my understanding is this one actually does not have a sunset provision, which I think there in and of itself is a really good thing. And it's indexed for inflation starting in 2027. So that number is going to continue just to creep up over time as inflation does its thing. But I'm hopeful that until there's future legislation, this kind of puts to bed kind of this whipsaw of an environment on estate planning. So for my entire career, pretty much, it's always been like, okay, well, the limit is here, but in a year or two, it's going to go down here. And then right at the 11th hour, my favorite was in 2010. 2010, there was zero estate tax for 1 year. There was a billionaire that passed away, so his family hit the jackpot on that. But in 2012, it was slated to go from like $5 million to $1 million. And on January 3rd of the year that it was slated to go down, they went back and retroactively fixed it and passed it. But there were a ton of estate planning attorneys working 100-hour weeks leading up to that, doing gifting and everything else just to meet that cliff that ultimately ended up being a non-event. And even in the last couple of years, we've been discussing the possibility of it going down and encouraging gifts and things like that. So to kind of take that dynamic away, I think will lead to a lot more certainty for our taxpayers, and then also kind of remove some of this false urgency on dealing with some of these estate matters and gifting. There's no impending cliff. So still a thing to watch and monitor, but it's not necessarily this urgency of, okay, I got to get these gifts in by the end of the year or else.
Well, if you talk about 15 or $30 million, sounds like a lot, but you get a business that's $2-3+ million of EBITDA, depending on your industry and whether you're married or not, you can hit $15 to $30 million in just your business value, just like that, which is a good thing for the business. But when you're doing, to your point, John, estate planning, you got to take into consideration what's the value of my business, and then what other assets.
Yeah, well, and especially if you're thinking about an exit, you can get a whole lot more value shifted or transferred while the operating business is still a going concern, rather than transferring cash after a sale. So that's one of the things. If you're looking for a sale in the next 5 to 10 years, it's a good idea to really stop and say, gee, should I do any gifting or should I do any estate planning now while the values are locked in at a certain level? So that way, when I realize an exit, as I'm continuing to grow that value and everything else, I've transferred a lot of wealth, tax free. And I've had clients take advantage of that in the past, and it has been a very good move for them to do that.
Well, and on this show, our viewers, you all heard, we're all about value. What adds value? When everything we talk about is some way adding value, which then is ultimately leading to some sort of transition, whether you like it or not, voluntary or involuntary, there's going to be some transition. So making sure that you're aware of these provisions, doing all the other things to build your company, grow it, and then execute upon them, kind of working in tandem with one another to make sure you're not only getting the most you can out of it, but retaining the most for you, future generations, what that looks like for you. But there is going to be some sort of transition. So I think this is, I agree, John. I think it sounds like it takes a lot of that pressure, that immediate pressure off, but we still want to remind you, hey, those are things to still be in consideration of, especially in coordination with whatever that transition may look like for you and your company. So
the statistic I heard was 100% of business owners transition their business at some right.
Pretty solid track.
They got that data from. So, all right. So we're getting close here, but John and Kris, it's August, so we're past that point in time. We're more than halfway through the year. A lot's already happened, but there's still a lot of year left in this year to go. So what should we be doing? I mean, everything you've explained says there's just not a straight answer on any one specific topic. So what should we be doing between now and the end of this year, and then sort of thinking outwards?
I think that starts with tax planning. I'm a big fan of understanding the current state, right? So like when you're looking at tax planning and doing some projections and really just trying to understand where am I at today, right? Like if I just basically just said, okay, we're not going to do anything. We're just going to file and pay our taxes. Where are we at? And then we start layering in and saying like, okay, well, do I do any research and development activities? Does it make sense to take a deeper look at that to see if I could take advantage of any of those credits? What's my capital budget like for this year, next year, and beyond? Are there any purchases that I've been putting off that maybe I could accelerate, that I can get an ROI for if I do that? What does my estate plan look like? What is the value? What would happen if I were to pass away unexpectedly? Is there an estate tax that's due? And start ask questions and understand what the tax ramifications are, because I think that's where we or any other CPA can really provide a lot of value, is helping you strategize and plot forward and help to minimize some of those current tax obligations. And then, look forward and plan for the future. And what does that look like on a go forward basis?
Right.
Yeah, I'd add to that and say, really, really work with your advisors to not make decisions in a vacuum. So, the thing that with a lot of these provisions, there's so many things at play. We talk about like accelerating depreciation. Does that have an interest expense limitation? There are a lot of other limitations that could come in and, that limit losses and things like that. So really work with someone to understand so that you're not making one decision that's going to affect other things and that you kind of shoot yourself in the foot. Thinking through what are my goals? What are those things that I want to do? And like John's saying, like, does it make sense to push something into 1 year versus another? Because, you're looking at the holistic picture.
Yeah, absolutely. I appreciate both of you, Kris and John, on your insights on this. We're really super excited about what this means for manufacturing, but at the same time, as you guys pointed out, there's a lot of planning that needs to go into this. And, Kris, to your point, I think it's more than just looking at, hey, what's going on this year? What's the plans over the next 3 to 5 years, especially if there is an exit plan to some point in the next 3 to 5 years, or you're looking at doing major investment into your operations. There's all sorts of benefits, at least tax-wise, that can help cash flow the earlier term of this. So extreme amount of planning here and opportunity, and we're looking forward to it. So once again, thank you both for being on the show and going through and explaining all this to everyone.
Yeah, thanks for having us.
Thanks for having us.
And to our listeners, viewers, thank you as always. And of course, any questions or you're ready to get going on planning, please give us a call and we'll be happy to chat.
To learn more about James Moore & Company's manufacturing services, go to jmco.com. And don't forget to subscribe to our More on Manufacturing series to receive updates when new videos and podcasts are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us on our website. You can also follow us on social media for more news as the landscape on manufacturing continues to rapidly evolve.